Joining me now with $1.1 trillion in assets under management, LPL Financial senior market strategist Ryan Detrick and NatWest Markets co-head of global economics Michelle Girard. Well, Michelle, no surprise, except maybe that we will see a Fed rate hike every single meeting this year. What else popped out at you that makes this more significant?
Yeah, I mean, you're right. No surprise that they raised rates today, but a real surprise in terms of the number of rate hikes that they anticipate this year, 7 in total versus in December, they thought it would be, 3, and we actually thought it would only move to 5. So more rate hikes this year. Also, more rate hikes next year, so that now you have the committee thinking that the funds rate will rise above 2.75%. That's above their neutral rate. So you've got a committee saying now it's not going to be enough just to get rates back to neutral. To get inflation down, we might have to actually raise rates into restrictive territory.
Well, that would have been a shock. But Ryan, are you surprised that the markets are okay with this? I mean, look at the NASDAQ, up more than 2%. Yep. We're almost up 3% here, 387-point jump. Normally, tech stocks might get to be a little squishy and nervous in that kind of atmosphere, but here we are. So what does this mean for individual sectors that you're looking at right now that could do really well?
Yeah, Liz, we're not that shocked. If you look at what happens the very first day of the first hike of new cycles, usually stocks do go up, right? The last 6 cycles after the first hike, the S&P is higher a year later, all 6 times. So it's not too surprising. Everyone's been worried, rightfully so, about all the scary things that are out there. But usually when the Fed starts hiking, what does it mean? It means we're more mid-cycle. We looked, it was like 3 years on average after the first Fed rate hike before the S&P peaks, right? So those are some things people need to remember. This is just more normal taking off the training wheels. Now, where are we? What do we see? Well, we still like the cyclical value names, right? The ones that kind of brought us to the party. I know yields have pulled back a little bit here, but still, if yields keep going higher, we still like, financials in general. Energy's had a great run, maybe a little more pullback. Financials, materials, energy still look pretty good. So those are groups that we brought to the party, and we'd still stick with them here.
Yeah, and financials are looking pretty strong at the moment, and so are Michelle, some other areas that will start to feel the effects of higher rates. And that would be, I'm thinking, look, people better get ready for higher credit card interest rates, right? And we're looking at American Express, MasterCard, Visa, Discover Financial Group. They're all moving higher at the moment. When you think about what Powell said regarding the pace of rates, I first want you to listen. This jumped out at me. Whether he would see, whether they would front load some 50 basis point hikes at certain points versus spread it out in individual chunks throughout the year. And then you can comment on what that really means for sectors that are interest rate sensitive. Here's Powell.
We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the S&P, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that, but I will say this, though, we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Michelle, I so thought that would spook the markets, but it didn't.
Well, the thing is, I think the main message from and he said over and over again in the press conference was getting inflation down, not allowing higher inflation to become entrenched in the system is the main focus of the Federal Reserve, because high inflation is so damaging to the economy and so damaging to purchasing power. You talk about the headwinds that consumers will face. They will face headwinds if inflation keeps rising. So if that means that by front-loading rate increases, they think ultimately they can get inflation capped sooner, such that the total number of rate hikes are less than what would have to be a case in a more worrisome scenario where inflation overshoots. That's their goal. So I think that that's really what they're deciding is if we can go sooner to get inflation under control, then that's better than dragging it out and ultimately have to go a lot further than we would like.
Yeah, we're looking at the financials, ETFs, the big ones, and then, of course, the regionals are looking extraordinarily strong, Ryan. What about the home builders? I'm interested to know what you think, because the 30-year fixed mortgage it has definitely gone well ahead of the 10-year Treasury yield, as not in actual numbers, but as we continue to watch exactly what's going on there, it started to move well ahead of any kind of rate hike.
Yeah, I mean, yeah, longer end, 30-year, those are breaking out. I mean, that potentially can impact home builders. I'll tell you what, real estate in general, though, it's a group, as this reopening keeps taking place, we are a little more optimistic on that front. I mean, it's you got to think about 2 years ago right now, Liz, you know what happened? Remember? It was the second worst day in the 125 years of the Dow, down over 12%. Here we are 2 years later. You know, we've seen bad times before. The big question is how much bad stuff is priced in. We're bouncing. Fed kind of sounded hawkish, but we're bouncing today. So much negativity has been priced into this market, rightfully so. Look at March 2003, March 2009, March 2020. History doesn't repeat, but it often rhymes, said Mark Twain. Could we be making another major market low in the month of March with negativity off the charts? We think there's an opportunity there, and that's probably pretty likely in our view.
Yep, yeah, and I think there's really no fear in this market of anything that happened today. I'm looking at the VIX right now. It is down about 10%, so volatility doesn't seem to be in this market. Ryan, Michelle, wonderful to have you on a very, I guess, historic day. First time we've seen a rate hike in more than 3.5 years.